Is your money actually invested in the right strategy for your age and your retirement timeline? Could you answer that confidently? Most people in their 40s can't. Not because you don't care, but because investing often goes on autopilot. Somewhere between work, family, and everyday life, no one stops to ask, does what I own in investments actually match my retirement timeline? Building wealth is not just about picking investments, it's about building a portfolio that matches your stage of life and retirement goals. So, by the end of this video, you'll know how to evaluate whether your own portfolio actually makes sense for your age, risk tolerance, and retirement timeline. I'll compare two mid-cap growth companies along with a small cap growth and mid-cap growth fund side by side. And I'll show you exactly how I research these investments, how I earn the money to invest, and how I make real investment decisions using my own money. If you're new here, hi, I'm Kelly. I invested privately for over a decade while working in corporate finance. I started investing at 35, and 8 years later, I left my corporate finance career and became financially independent. Now I'm building a portfolio publicly from $10 to $1 million using my own money and walking you through the research, strategy, and reasoning behind every investment decision so you can learn how to build your own portfolio with confidence. So if you want to learn how to build wealth rather than watch random finance videos, subscribe and hit the bell so you don't miss a single episode. In the last episode, the risk versus reward wheel landed on small and mid-cap growth. If you want to watch that video, I linked it below. Today, I'm closing the loop because knowing what small and mid-cap growth are is only half of the equation. The other half, the part most investors skip, is the strategy behind small and mid-cap growth and knowing whether either one actually belongs in your portfolio right now. And that answer depends on three things specific to your age, your risk tolerance, and your timeline. For me, I'm in my mid-40s and my risk tolerance is growth oriented. And my goal is to reach $1 million in roughly 10 years. So deciding between small mid-cap growth and my age with a 10-year investing goal, small cap carries too much volatility for my window. I'll explain why in a minute. Mid-cap growth sits in the sweet spot with proven companies still growing fast with less extreme swings. A far better fit for where I am right now. Now, before you see my portfolio, ask yourself these same three questions. What's your age? How many years do you have before you need this money for retirement or other goals? And what is your risk tolerance? Because in a few minutes, when you see exactly how I made this decision, you'll be able to apply that same thinking directly to your own situation. Here's my actual portfolio right now. I started investing in this portfolio 4 months ago, and my portfolio has mostly large cap US stocks. And if you own a 401k or a brokerage account that has been running on autopilot for years, there's a very good chance your portfolio looks similar. Heavy on large caps, light on growth categories that could move your portfolio faster in years you have left before retirement. That's the gap I'm addressing today. So before I show you what I researched, let me explain one concept that makes everything else make sense. Asset allocation, which means deciding how to split your money across different types of investments and the percentage for each investment. Think of your portfolio like the risk versus reward wheel I'm basing this series around. Every category inside your portfolio serves a different purpose. Some investments are designed for growth, some are built for stability, some reduce risk, others increase opportunity. So it's not just what you own. The question is how much of your portfolio is allocated to each category. What percentage of your total portfolio is in growth right now? What percentage is in stability? What percentage is actually working to get you to your retirement on your timeline? Because how you slice this wheel determines how your money grows over time. And after you watch this video, I want you to look at your own portfolio and ask, is my money intentionally allocated across the right categories? Or am I just holding investments someone chose for me years ago? So before I show you what I bought, let's dig into the research that helps make this decision confident instead of random. This is important because I've done the research to simplify it for you, but I also want you to understand the thinking behind it so you can eventually make confident investing decisions on your own, because that's the real goal of this series. Today, I'm focusing on mid-cap growth because if you're in your 40s, this could be a great asset category to add to your portfolio. Mid-cap growth companies are publicly traded businesses with a total company value between 2 billion and 10 billion that have already proven their business's model work and are still growing fast enough to have meaningful upside potential. Here are two mid-cap growth stocks as of today. Company number 1, DigitalOcean. In April 2026, DigitalOcean moved from small cap to mid cap growth. DigitalOcean is a cloud computing company whose aggressive expansion in AI services give developers, startups, and small businesses a simpler way to build websites, apps, and software online. The growth driver of this company is millions of underserved small businesses who need affordable, simple cloud solutions. So, what to watch for with this company? First, is revenue actually growing? Second, is the stock price reflecting that growth? And third, is the company actually profitable? Later in the series, I'll use my corporate finance background to dig into these types of questions further. Company number 2, Onto Innovation. Think of Onto Innovation as the quality control behind every AI chip made. Before a chip ever reaches your phone, your laptop, or data center, it has to pass inspection. Onto Innovation makes the machines that do this inspection. The growth driver is simple. The more AI grows, the more chips the world needs, and every single one of those chips has to be inspected. Onto Innovation shares soared 204% over the past year. So, what to watch with this company? Well, Onto Innovation relies on just a few major customers for most of its revenue. If one of those customers slows down their orders or switches suppliers, it directly impacts the company's bottom line. Here's why I'm showing you individual companies, even though I'm investing in an index fund today. Because when you understand what you own and why it's positioned to grow, you stop reacting emotionally every time the market drops. That is the investor that you're becoming by watching this. Now let's discuss my index fund decision. And this is where your age, your risk tolerance, and your timeline do all the work. Watch how these three factors make the choice clear. Option number 1, VBK. VBK represents small cap growth, one of the highest risk, highest reward categories on the risk versus reward wheel. So why do investors choose small cap growth? Well, because small companies have the longest runway for growth. A company growing from 500 million to 5 billion is far more realistic than a $3 trillion company becoming $30 trillion. That upside potential is why younger investors with a 15 to 20 year timeline are often drawn to this category. But there's a trade-off. Small cap growth can drop 30 or even 40% during difficult markets. Some companies fail completely. Others can go sideways for years before recovering. This category is not designed for stability, it's designed for acceleration over the years, which is why many investors use small cap growth as a smaller allocation inside their portfolio, not the foundation of it. But here's the honest question to ask about VBK. If this fund dropped 40% next year, how many years would you realistically need to recover before you start drawing from this money? Here you can see VBK took 4 years to recover. For someone with a 20-year runway, VBK can make a lot of sense. But for someone with 7 to 10 years until retirement, that recovery window becomes much tighter. VBK is a great fund, but it's simply designed for a different timeline than mine and possibly yours. Now let's look at option number 2, a mid-cap growth fund. Mid-cap growth sits in what many investors consider the sweet spot between growth and stability. These are companies that are already proven but still have meaningful room to expand. This just means less uncertainty than small caps and more growth potential than large caps, and generally less extreme volatility overall. For investors with a 7 to 10 year timeline, mid-cap growth often acts like a bridge between aggressive growth and portfolio stability. So let's look at IMCG representing mid-cap growth and compare the recovery time versus small cap growth VBK. Remember how small cap growth took 4 years to recover? Well, during that same timeline, mid-cap growth took 1 year less to recover. The recovery window is a lot quicker than small cap growth funds. This is why knowing your time horizon goal is important based on what you're investing in. So today, because of my age, risk tolerance, and timeline, I'm adding a mid-cap growth fund to my portfolio. I'm still in the early stages of building this portfolio, so I'm not choosing to invest in an individual stock just yet. And IMCG fits all three filters for now. IMCG gives me room to absorb market volatility without completely derailing my timeline. That is what intentional investing looks like. Here's a bar chart for IMCG versus VBK returns over the last 10 years, side by side. And I also included which fund won each year. Overall, IMCG won 7 out of 10 times over the last 10 years and averaged 14% returns over the last 10 years, compared to 11% for VBK. So now that you understand why I chose this category, let me show you how am I actually finding the money to build this portfolio in real time. Well, one thing I committed to in this series is complete transparency about where my money comes from. Today, I'm investing $74.47. It came from interest in my high yield savings account, cash rewards from my credit card, and dividends from my current portfolio. That's what happens when you stop letting money sit idle and start putting it to work. Now, I know what some of you are thinking. $74, that barely covers groceries for the week. But here's what I want you to hear in that number. The investors who build real wealth over time are not the ones who make the biggest single deposit. They're the ones who never stop, who reinvest everything, who treat every dollar like it has a job, who stay consistent even when the amount feels too small to matter. And that $74.47 invested consistently, month after month, year after year, compounds into something that matters enormously by the time you reach retirement. So here's the investment. If you learned something new and are leaving this video with a clearer picture of your own money, start investing in yourself and hit subscribe, because the investor that you are becoming by watching this series is someone who makes decisions with confidence, not hope. Also, share this video with a person in their 40s who has been thinking about investing but doesn't know what the right next step looks like. This might be exactly what they need. And in the next episode, I finally opened milestone number 2, and I want to celebrate it with you. I've created something specifically for you, the viewer, following this journey in real time. I'll be opening the envelope because I crossed $5,000 invested in just 4 months. Every dollar came purely from being resourceful and finding money that was already available to me, not from a 9-to-5 job. That is the strategy anyone can use. You won't want to miss it. See you next week.